Hello everyone and welcome to Managerial Accounting. In this chapter we're going to go over the variable costing for management analysis. So chapter 21 will start with comparing absorption costing to variable costing, and then we'll focus more on variable costing. So under absorption costing, the cost of goods manufactured includes direct material, direct labor, and factory overhead. So remember, these are the three main components when we are calculating the cost of goods manufactured, which is direct material, direct labor, and factory overhead. Both fixed and variable factory overhead are included as part of the factory overhead. So when we are thinking of direct material, direct labor, these are technically variable cost. But when we talk about factory overhead is a combination of fixed and variable factory cost. So the reporting of operating income under absorption costing would be as follows. We have the sales for the period, we subtract the cost of goods sold to get the gross profit, and then we subtract the selling and administrative expenses to get the operating income. So that's technically how it works. Okay? So in absorption costing, I think it just works in the same way we've been learning how we calculate our cost of goods sold and gross profit and the operating income under in 1A or financial accounting. So variable costing would be slightly different. Under variable costing, sometimes we call it direct costing. The cost of goods manufactured include only variable manufacturing cost. So the fixed factory overhead portion is not included. So the cost of goods manufactured consists of direct material, direct labor, and only variable factory overhead, not the factory overhead total. So under variable costing, fixed factory overhead costs are not part of the cost of goods manufactured. So I hope we notice that. So how we calculate our operating income? We start with the same thing. We have sales, then we subtract from it variable cost of goods sold. Okay, let me go back one slide. See here we have the cost of goods sold. In the variable costing, we're going to use variable cost of goods sold. And then that would give us the manufacturing margin. Out of manufacturing margin, we are going to subtract variable selling and administrative expenses to get what is called contribution margin. Out of the contribution margin, we're going to subtract two fixed costs, the fixed manufacturing cost and the fixed selling and administrative expenses. And that would give us the total fixed cost, which we subtract from the contribution margin to get the operating income. So that's how we calculate the operating income under variable costing. So manufacturing margin, again one more time, just to review what we talked about here. Manufacturing margin is the sales minus variable cost of goods sold. In other words, it's the excess of sales over variable cost of goods sold. And if you go here, that's what we get, how we get the manufacturing margin. It's sales minus variable cost of goods sold. The variable cost of goods sold consists of direct material, direct labor, and only the variable portion of factory overhead for the unit sold. When we subtract the variable cost of goods sold from the manufacturing margin, we get the contribution margin. So contribution margin is the excess of manufacturing margin over variable selling and administrative expense. So when we subtracting fixed cost from the contribution margin, this would yield operating income. So operating income is the contribution margin that we just calculated minus the fixed cost. So if I go back one slide again, we got the manufacturing margin, which is the sales minus variable cost of goods sold. And then when we subtract the variable selling and administrative expenses, we get the contribution margin. Then we subtract the fixed costs, the total fixed costs here, to get the operating income. So you see here, it's a three-stage process under variable costing. If I go back one more slide, in the absorption costing, it's only two steps. So we have sales minus cost of goods sold would give us gross profit, and then we subtract selling and administrative expenses, and we get the operating income. There's no margins or contribution margin or manufacturing margin to calculate. So here we have to calculate the manufacturing margin, the contribution margin, and then we get to the operating income. So this exhibit here compares absorption costing versus variable costing, or compares absorption costing to variable costing. So you see, in absorption costing, the cost of goods manufactured include direct material, direct labor, and factory overhead total, which includes the variable factory overhead and the fixed factory overhead. Under variable costing, how we calculate the cost of goods manufactured is slightly different. It's direct material, direct labor, and the variable factory overhead. And that would be the inventory value. And the fixed factory overhead, that would be part of the period expenses. Due to the difference between absorption costing and variable costing, the value of inventory would be different based on which method we're applying. So inventory would not be the same. So let's see an example. This example shows variable costing and absorption costing and how the numbers would be different. So here we have the manufacturing cost. They say here, assume that Martinez Company manufactures 15,000 units, which are sold at a price of $50. So that's the selling price. The related costs and expenses for the company are as follows. We have their variable cost, we have their fixed cost. These are the costs, and you can see here the number of units that we just got here. And these are the unit cost. And we get a total manufacturing cost of $525. And then the selling and administrative expenses are also variable and fixed for the same number of units. And per unit for the variable part is about $5 each. And the fixed selling and administrative expenses are only $50,000. So we have manufacturing cost of $525. We have selling expenses of $125. So under absorption costing income statement, we start with the sales, which is the 15,000 multiplied by 50, and that's $750. We subtract the cost of goods sold, which is 15,000 multiplied by 35, and this is the 35 that we got here, which is the manufacturing cost here. So $35. So that would give us the gross profit, which is $225. We subtract the selling and administrative expenses, 75 and 50. Again, these are these two numbers. And that would give us our operating income of $100,000. In this case, since our units sold is the same as our production, the operating income would not be different whether we are using the absorption costing or variable costing. So in the next exhibit, we see the variable costing. So this is how the variable costing income statement would look like. And before going into the details, you can see that operating income would be the same. So in Exhibit 2, the operating income is $100,000. In Exhibit 3, the operating income is still $100,000. But let's see how they made the calculations. The sales were 15,000 multiplied by $50. That's $750, exactly as we had before. The thing that would be different, we don't have cost of goods sold. We have variable cost of goods sold, and that's 15,000 multiplied by 25, not 35 as we had before. See, that was broken down to variable and fixed. In the absorption costing, we use the 35, which is the total manufacturing cost. In variable costing, we only focus on the variable manufacturing cost, which is the $25 each. So variable cost of goods sold, which is 15,000 multiplied by 25, that's 375. That would give us a manufacturing margin of 375. Then we subtract the variable selling and administrative expenses, which was $5 each for each unit. We sold 15,000 units, so the total is 75. We subtract that from the 375, we get the contribution margin. And that's our next step. The third step is to subtract the fixed cost. And we have two types of fixed costs. We have the manufacturing cost and we have the selling and administrative expenses. 150 and 50 for a total of 200. We subtract them from the 300,000. We get an operating income of 100,000. So as you can see here, since our sales were the same as our manufacturing, our operating income for both cases were the same. You can see here, the 100,000 is the same. Now let's talk about the effects of inventory. So operating income will vary between absorption and variable costing depending upon whether there is any change in inventory. So again, if the units manufactured equal units sold, this would result in no change in inventory. And the two methods would give us the same operating income. When units manufactured exceed units sold, this results in an increase in inventory, and that's normal. when we manufacture more than we sell, then we will have more inventory, and our inventory will keep increasing. If the units manufactured are less than the units sold, which is possible because we are selling part of our old inventory, so in this case, this would result in a decrease in our inventory. So let's say we had 10 units, we produced 50, but we sold 55. So now our ending inventory would be only 5, because in our sales, we sold the entire amount that we manufactured and part of our beginning inventory. So our ending inventory would decrease. So when the number of units manufactured equal the number of units sold, operating income will be the same under both methods, whether it's variable costing or absorption costing. When units manufactured exceed the units sold, if we manufacture more than we sell, the variable costing operating income would be less than it would be for absorption costing. But on the other side, when the units manufactured are less than the number of units sold, the variable costing operating income will be greater than of absorption costing. So let's see an example to make this a little bit clear. So here we have two income statements, one for the variable costing under income statement and one for the absorption costing. Again, for their income statement. You see here the sales are the same. We sold 12,000 units at 50, and there were 600,000 in both cases. Remember, the variable costing income statement, we have 3 steps. We have to calculate the manufacturing margin, we have to calculate the contribution margin, and then the operating income. So to get the manufacturing margin, we have to subtract from the sales the variable cost of goods sold. In the variable cost of goods sold here, we have the variable cost of goods manufactured, which is 15,000 multiplied by 25, and we subtract from that the number of units available or ending inventory to get the number of cost or number of units that we sold. So remember, we produced 15, but we only sold 12. So our ending inventory would be 3,000. So we subtract 3,000 multiplied by 25 from the 15,000. So that would be 75,000 out of the 375. That's 300,000. So the total variable cost of goods sold to be subtracted from the sales is 300,000. That would give us our first number, which is manufacturing margin, to be 300,000. Then we subtract the variable selling and administrative expenses, 12,000 at 5, and that would be 60,000. And the contribution margin is 240,000. And that's the second number we're looking for. Keep in mind, we're using the same numbers that we had before in the previous example. Then the fixed cost. Here we have the fixed manufacturing cost. We have the fixed selling expenses. We add them together. That's 200,000. We subtract it from the contribution margin. We get an operating income of 40,000. So let's see if we're using the absorption costing, how the operating income would look like. Again, the sales is 600,000, same value as sales. Our cost of goods sold, it's done the same way. We have the cost of goods sold manufactured, 15,000, multiplied by 35, but here it's 35 instead of 25, so it's 525. And then the ending inventory, 3,000 multiplied by 35, it's 105. So now our total cost of goods sold, and remember, the total cost of goods sold includes the variable cost of goods sold and the fixed cost of goods manufactured. I mean, the variable and the fixed cost of goods manufactured. So the total cost of goods sold would be 420. If we subtract the 420 from the 600,000, the gross profit would be 180. Selling and administrative expenses would be 12,000 multiplied by 5 plus the 50,000, because both of these are fixed cost. I mean, like the total selling and administrative expenses were the variable and the fixed cost, which is 110. We subtract the 110 from the 180, and the operating income would be 70. Notice that the operating income under variable costing is less than the operating income under absorption costing when the sales were less than manufacturing, because we manufactured 15 but we only sold 12. So in this case, our operating income under absorption costing was higher than under variable costing. Now assume that beginning inventory, units manufactured, and units sold for the company that we've had were slightly different. We have beginning inventory of 5,000. We manufactured 10,000 and we sold at the $50 per unit 15,000. So in other words, we sold more than we manufactured. So what would happen in this case? And here we have the beginning inventory, we have the current period manufacturing cost, and we have the selling and administrative expenses. So let's see how that would look like if the units manufactured are less than the units sold. And in this case, we'll start with absorption costing. Remember, absorption costing, we only have two stages. We calculate gross profit and we calculate operating income. How we get to gross profit? It's simple, as we've done in financial accounting. Sales minus cost of goods sold. But how we calculate cost of goods sold? It's the beginning inventory plus the cost of goods manufactured. Since we don't have an ending inventory, the ending inventory is going to be 0. So that would give us the total cost of goods sold. So beginning inventory was 500 at 35, which is 175. Cost of goods manufactured were 10,000 at 40. Then we have 400,000. So the total would be 575. We subtract 575 from the 750 to get gross profit of $175,000. And that's the first step. We subtract selling and administrative expenses, both variable and fixed. See, let me go back here. Selling and administrative expenses, we have variable and fixed. We add them together, 125,000. If we subtract it from gross profit, we get an operating income of 50,000. Let's see the variable costing income statement. 3 stages. We have to calculate manufacturing margin, contribution margin, and then operating income. So to get to the manufacturing margin, we do the same thing, the sales, 750, same like the absorption. Then we have the variable cost of goods sold. Remember, it's not just cost of goods sold. We only focus on the variable cost of goods sold. So we get the beginning inventory plus the variable cost of goods manufactured. So with the 5 and the 10,000, both at $25 each. So we get 125,000 and 250,000. We get the total variable cost of goods sold, which is 375. Subtracted from the 750, we get manufacturing margin to be 375,000. And that's the first step. Then we go to calculate the contribution margin. We subtract the variable selling and administrative expenses. That's another 15,000. That's the total sold multiplied by 5, which is 75,000. Okay? That would give us a contribution margin of 300,000. The last step to get the operating income, we have to subtract the fixed cost, both manufacturing and selling. So we get the 150, the 50,000, we add them together, that's 200,000. That would lead to 300,000 minus 200, an operating income of 100,000. Notice that when we sold them more than we manufactured, in this case, the variable costing led to a higher operating income compared to the absorption costing, which is opposite to what we had before in the previous example. Please try to keep this in mind. It's good material for questions. So one more time, to summarize this. When the units manufactured, if the units manufactured equal exactly the units sold, so I manufactured 100 units, sold 100 units, then the absorption costing operating income and variable costing operating income would be the same. Okay, because we're not transferring any part of the fixed cost to the future inventory. But if units manufactured is greater than the units sold, in other words, we'll have part of our ending inventory absorbing the fixed cost under the absorption costing, then the absorption costing operating income would be higher than the variable costing operating income. Again, if the units manufactured is greater than the units sold, then absorption costing operating income would be higher than variable costing operating income, because our cost of goods sold would be higher in this case. If the units manufactured are less than the units sold, okay, if the units manufactured less than the units sold, in other words, we end up increasing our ending inventory, our absorption costing operating income would be less than the variable costing operating income. The variable costing operating income in this case would be higher. Okay? So, let's do a quick knowledge check here. Under variable costing, fixed factory overhead costs are considered what? Is it part of the cost of goods manufactured? Is it part of period expenses? Is it part of gross margin? or is it part of contribution margin? Remember, under variable costing, fixed factory overhead is excluded. We just consider it to be a period expense. Okay, so the right answer is B. It's period expense. So under variable costing, fixed factory overhead costs are not part of the cost of goods manufactured. Instead, fixed factory overhead costs are treated as a period expense. Alright, so let me stop here. In the next video, we'll continue talking about operating income using absorption and variable costing.